in 1988, John Slater wrote an article in the Wall Street Journal that used dividend yield combined with the Dow Jones Industrial Average to create one of the most interesting and well-researched strategies of all time. That strategy is called the Dogs of the Dow. The strategy was very popular for two reasons. The first is that the results of the strategy were extremely impressive, and the second reason, and probably the most important, is that it was very simple to implement. In this video, we're going to look at the historical evidence for the Dogs of the Dow strategy. We'll look at several different research papers that document different results, studying different periods. At the end of the video, I'll share my own research on how the Dogs of the Dow strategy has done from 2001 to 2023. I'll then show you three different strategies that I found that tested even better than the Dogs of the Dow. The final strategy is something that I'm calling the Dobermans of the Dow, and I think you're going to find it extremely interesting, both the results and the methodology to get there. I'll share that and which 10 of the Dow stocks are currently in that portfolio.
This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
So first, let's start with the Dogs of the Dow. What exactly is that? So the Dow Jones Industrial Average is a portfolio that's made up of 30 different stocks, and this is the longest running index in the United States. The Dogs of the Dow strategy simply takes the list of 30 stocks and ranks them by highest to lowest dividend yield. And then the strategy simply takes the top 10 dividend yielding stocks, and this becomes the Dogs of the Dow strategy. Each stock is equal weighted to start the year, and then at the start of the next year, you simply rebalance the portfolio back to an equal weight and change the holdings based on, whatever changes were made during the year. So, maybe number 8 had a dividend yield of 4%. And then at the end of the year, maybe that dividend yield drops down to 3.5, dropping it out of the top 10. And then something else, maybe that was yielding 3.3 is now yielding 4.3. So that would then become a member of the strategy. The original paper that was published in the Wall Street Journal in 1988 disclosed the 10 stocks that would have made the Dogs of the Dow portfolio at the time, and also some historical backtesting going back to 1973. Here were the Dow Jones top 10 dividend yielding stocks at the time. You can see the dividend yields ranged from 4.4% in DuPont all the way up to 6.4% in General Motors. Slater found that from 1973 to 1988, this simple Dogs of the Dow strategy returned an astounding 18.4% annually, compared with just 10.8% for the entire Dow Jones index. The authors of the book Beating the Dow, published in 1991, expanded the research to include 1973 through 1991. They found very similar results. The Dow Jones 10 highest yielding stocks returned 16.61%, while the Dow itself only returned 10.4%. However, not all of the research on the Dogs of the Dow was favorable. There was another study that was published in 2005, and this study showed that from 1990 through 2005, a period which included the massive tech bubble in the late 1990s, the Dogs of the Dow strategy actually produced a geometric average of 10.76% per year, compared with the regular Dow Jones producing 11.47%. Not only that, but of course the Dogs of the Dow, having less holdings, had a higher standard deviation. So at least during this time period, the Dogs of the Dow strategy produced both lower returns and had more volatility. So how would the Dogs of the Dow strategy have done in more recent years? So what I did was I took the Dow Jones 30, and just like the other research papers, I sorted it by the highest dividend yield to the lowest dividend yield and just simply selected the top 10, rebalanced once per year, just like the other research papers suggest. And what you can see is that the screen, which is the Dow Jones 10, my results, These are represented by this red line, and the blue line is just the Dow Jones 30. And consistent with the paper that studied 1990 through 2005, I also found that the dogs of the Dow underperformed the regular Dow, returning just 406% compared with the Dow Jones average at 425. Just like the other paper, I also found the standard deviation was higher, and most importantly, in my opinion, the maximum drawdown was quite a bit worse for the dogs of the Dow strategy. It fell 67% in 2007 through 2009, compared with just 52% for the Dow Jones average. So, based upon the most recent research and my own research, I would say that the dogs of the Dow strategy might actually just be a dog that we should shoot. I don't think it's something that appears to be very helpful for investors as far as increasing your returns versus the Dow. You're probably better off just investing in the Dow, not trying to do the dogs of the Dow strategy. However, are there other metrics that might work using the similar methodology, but instead of using dividend yield, we use different criteria? To find out, I started looking at different metrics. The first one I looked at was shareholder yield, which, as you know, if you watch my channel, I really prefer that, which combines dividends and buybacks or dilution. So when I replaced dividend yield with shareholder yield, the results improved quite substantially. You can see that my new dogs of the Dow strategy using shareholder yield, now you get outperformance, 481 versus 425. You also see that the maximum drawdown is very similar to the overall Dow, and these ratios, risk-adjusted Sharpe and Sortino, are both favorable for this modified dogs of the Dow strategy. So replacing dividend yield with shareholder yield was certainly helpful to performance, but I found one that worked even better. In this test, I took the average 5-year free cash flow and I divided it by the market cap. There was some good and some bad for this study. The obvious good is that this screen generated 647% total returns compared with just 425 for the Dow. The problem, however, is that the maximum drawdown was again over 60%, which is probably too much for most people. Still, the higher returns more than made up for the additional risk, with the Sharpe and Sortino ratios both significantly better than the Dow index. But there was one that worked even better than free cash flow yield, and that was using my personal favorite, return on capital employed, which is a variation of return on invested capital that excludes cash from the balance sheet when calculating the returns. And this strategy was absolutely incredible. It was so good that I have given it its own name, the Dobermans of the Dow. Try to think of a dog breed that was better or more quality, so to speak, than just a dog. So I thought Dobermans was a bit more sophisticated. But so what this strategy does is the same exact methodology. We rank all the stocks in the Dow, only this time the metric is 5-year average returns on capital employed. And so this is the metric that, in my opinion, best estimates whether a business has a wide economic moat or not. Businesses that earn very high returns on capital employed are able to compound money very quickly. The problem in a lot of cases is that they don't have as many reinvestment opportunities, but still it's an indicator of an economic moat. And the results of this study were shocking. Take a look at the screen. The red line represents the Dobermans of the Dow strategy. The total return was 762%, which is an annualized pace of 10.2%, and that compares with the Dow Jones at 426. You can also see the maximum drawdown was significantly improved. Top to bottom decline was negative 40.5%. The Sharpe ratio and Sortino ratio were significantly higher, and not only that, but you see the standard deviation actually was lower than the Dow, even though this strategy only had 10 stocks. This is a very interesting result. I took a look at which stocks would have been in the portfolio if you had started that today. Here is a list of the current top 10 Dow Jones stocks ranked by return on capital employed over the last 5 years. It's a very impressive list. You see you have Apple here at 48%, Home Depot is even better at 51%, and then the rest of the stocks range between 23% and 29%. But just looking at the names, this is an extremely high quality portfolio with a nice mix of businesses that have real long-term growth drivers like Visa, Home Depot, Apple, Microsoft, and Nike, combined with some stalwarts that are just cash cows, extremely high quality like Johnson & Johnson, McDonald's, Merck, Procter & Gamble, and Cisco. I'm considering starting an experimental portfolio where I'll track the Dobermans of the Dow going through time, just like I do on my Patreon page. I currently do the coffee can portfolio strategies that I've started now up to 9 of those. So I may add another experimental strategy here. I haven't yet decided if I will or not. So what do you think of the Dobermans of the Dow strategy? Let me know down in the comment section below. Thanks for watching, and I will see you in the next video.